This is Business Weekend with Edward Boyd.
Hello and welcome to Business Weekend. I'm Edward Boyd. Coming up, copper prices are back trading near record highs due to supply disruptions and soaring demand for the base metal, which is used in growth sectors like electric vehicles, energy infrastructure and artificial intelligence. BHP is a major producer of copper, operating the world's largest mine in Chile, and its head of the Americas, Brandon Craig, will join us for an exclusive interview.
We're expecting the world to need an extra 10 million tonnes of copper by 2035, and that's a very material amount.
We'll also talk energy and the outlook for the supply of power in Australia with Daniel Westerman, the CEO of the Australian Energy Market Operator. This week, AEMO released its draft plan for the future of electricity, where it says the cost of revamping our grid from coal to a mixture of solar, wind and gas by 2050 will be about $128 billion.
Well, Australia's well and truly into the energy transition, and we're sort of 15 years in.
This year's been a feisty one for investors attending annual general meetings. Numerous companies have been hit with protest votes at their AGMs due to bloated salaries of executives, poorly appointed directors and subpar company performance. We'll wrap up the AGM season with Rachel Waterhouse from the Australian Shareholders Association and Megan Motto from Codex Communications.
It's not just the focus on company performance, which absolutely it should be, but it's also that behind-the-scenes governance expectation that's really lifted.
Plus, property prices have surged to record highs this year thanks to the Reserve Bank cutting rates 3 times. We'll discuss the highlights of 2025 for the property market with Anne Flaherty from REA Group and preview what's in store for 2026.
We're actually seeing an enormous amount of activity. So, for example, we've already seen a slowdown in the rate at which loans are being processed because of this upswing in first home buyer demand.
Global copper demand is expected to grow 70% by 2050, reaching more than 50 million tonnes per year. Dr. Copper is one of the most sought-after minerals right now due to its usage in artificial intelligence and data centres, along with electrification, wiring, piping and wind turbines. Australian mining giant BHP is well known for producing iron ore out of the Pilbara, but it's also one of the world's largest producers of copper, operating Olympic Dam in South Australia and some huge mines overseas. There's the Escondida and Spence copper mines in Chile, along with development projects in Argentina and the United States. Copper now comprises about 45% of BHP's EBITDA. BHP's President of the Americas, Brandon Craig, is responsible for the company's operations and projects in North and South America, and I spoke to him in an exclusive interview.
When you have a look at the world, it's rapidly trying to electrify. So if you have a look at everything from data centres to the penetration of electric vehicles, together with just traditional GDP demand growth, you can find that the demand on copper, which is a core material that feeds into the products that support electrification, that is actually producing the demand we're seeing for copper today. Now, for BHP, when we project forward what that actually looks like, we're expecting the world to need an extra 10 million tonnes of copper by 2035, and that's a very material amount. When you have a look at the current status of mining around the world, if it's 25 million tonnes currently, the world would need to bring on a substantial number of mines to be able to support that number.
Well, you're the president of BHP Americas. Just talk us through the major copper producing assets that you already have that are operating right now.
So we currently operate the world's largest copper mine. It's called Escondida and it's based in Chile. That mine currently produces between 1.2 and 1.3 million tonnes per annum. We also have a couple of smaller mines that operate in Chile. But importantly, we also have a copper mining complex called Olympic Dam, which we operate in South Australia.
Yeah, and from a mining operational perspective, just explain the attractiveness of open cut mining for copper like at Escondida in Chile compared to the underground copper operations that happen in Australia at places like Olympic Dam.
So I think what you find in Chile, the copper mines tend to be large porphyry mines. So on a relative basis to undergrounds, they tend to be somewhat lower grade. But the ore bodies themselves tend to be extremely large. So because of that, the combination of investment at scale into these large but somewhat lower grade ore bodies allow you to produce very high volumes, and the scale gives you low cost. For the underground mines to compete, for example, what we have in Copper South Australia, you tend to need to have a higher grade resource in the underground to support a competitive mining operation. So the geology is fundamentally different and the economic drivers are quite different. But I think the way you should think about the trade-off is porphyries in the Andes, which is Chile and Argentina, large volume, lower grades. The underground mines, whether you are in DRC or Zambia in the sedimentary deposits, or whether you are in Copper South Australia, just near our Olympic Dam business, that tends to be higher grade underground.
And I know in Chile it's at a very high altitude. Does that cause any difficulties as well?
Well, you have to manage health effects at altitude, which is really important. But I think what you find is a lot of the copper in Chile and Argentina tends to be based at higher altitudes. Our Olympic Dam mine is at about 3,500 meters. The project we have with Lundin that we're developing in Argentina, that mine is approximately 4,200 meters and may extend as high as 5,000 meters. Now, clearly, that's significant altitude. So you have to put a range of health programs in place to be able to manage that. But it is entirely manageable with the right protocols in place.
You ran BHP's iron ore business during the COVID era with lots of workplace disruptions. There have obviously been some pretty famous strikes at Escondida and the Spence mines in South America. I mean, how tough is it managing unionised workers in South America compared to Australia?
So my view is it's entirely manageable. I mean, we recently went through some union negotiations where there was some limited strike action. But Chile as a country has some pretty well-defined processes for how you manage the development of employment agreements between companies and the workforce. And those mechanisms have some pretty effective safeguards to make sure that negotiations can actually come to a conclusion within a reasonable period of time. So you do tend to see some of that action materializing in Chile, but it tends to be reasonably short-lived.
Chile also has a communist presidential candidate, Gianetta Jara. The runoff election is on the 14th of December. I mean, have you had much dealings with her or her party, and could business conditions in Chile potentially change if she does win this election?
So we currently have very good relationships with the Boric government, which is the government currently in power, of which Gianetta Jara is part of that same political group. So it's important to recognise that Chile is very much a mining country, similar to Australia. And both sides of politics in Chile tend to be pro-mining. So my experience from my time in Chile is we tend to get very good support. And recognising that there is an election coming due on the 14th of December, whichever party ultimately wins, I feel pretty confident that the mining industry, including for BHP, will be well supported.
All right, I want to talk to you about Argentina. President Javier Milei, he's just cemented his power there, winning the midterm elections. I mean, how pro-business is he since coming to power, and are his policies working? Are they encouraging companies like BHP to operate more in Argentina?
I think looking at Argentina, my assessment is the government is very determined to secure investment into Argentina. So if you put that into the perspective of the copper story, which is what we are interested in as BHP, Argentina is working to try and attract a big part of the world's sort of global copper demand that sits ahead of us. So as I mentioned at the start of this discussion, the world needs to develop 10 million tonnes of additional copper over the next 10 years to 2035. Argentina is competing to try and secure a big part of that opportunity. So when you look at the total set of projects in place, well, not necessarily in place, but being pursued in Argentina, there's approximately 1 million tonnes of prospective copper investment over the next 10 years. You turn that into a financial value, that would sit somewhere between $20 and $25 billion of investment, which is lining up to go into Argentina. And that is on the back of the policy settings that the Malay government has put in place for Argentina. So they have an incentive scheme for large investments, which they call RIGI. That incentive scheme produces very favorable tax rates. For example, the base rate of tax in Argentina is 35, but for people who get a RIGI approval, that rate will drop to 25%. It offers significant reductions in dividend taxation rates that apply for dividends getting paid outside of the country. And there's a range of other protections to make sure that the fiscal settings and the policy settings in place will be stable for extended periods. And those periods could be 30 to 40 years. So you put all of that together, and I think Argentina has put together a policy framework which, from the perspective of mining, is very attractive. And it's on the back of that, the work we've done with Lundin Mining to invest in the project we have in Argentina, which we call Vikuna. That incentive scheme is clearly a very big part of what makes Argentina attractive for both BHP and our partner Lundin.
Yeah, just talk us a little bit more about the joint venture with Lundin.
So the Vikuna project we have in Argentina is a resource discovery that came through the Lundin organization, which we think is arguably the best copper resource discovered in the last 30 years. The project itself sits right at the border between Argentina and Chile at high altitude, so it is at 4,200 meters, but it's very prospective. So the development of that project is something we're working actively towards with our partner. Lundin Mining, who we've joined up with, is very experienced at operating in Argentina. We have a project called Jose Maria, which is the first part of this venture, that is currently going through a series of studies to firm up what we think this investment is going to look like. In the first quarter of next calendar year, we expect the first technical studies to be completed. And the back of those technical studies, we'll understand where and how we plan to pursue that investment further. I think it's important to state, though, that the quality of the resource and the quality of the partnership we have with Lundin is certainly creating an investment which we are very excited about as BHP.
Okay, and just quickly, the United States, President Trump hosted your chief executive, Mike Henry, at the White House before meeting the Australian Prime Minister earlier this year. Does this really show how keen the President is on mining and job creation? And I know you've got the Resolution project there that's been held up for about 15 years. So the President Trump and the Trump administration is clearly very pro-mining and very focused on mining. So copper and obviously other critical minerals play a pretty critical role in economic self-sufficiency and security. So the government is actively pushing for the development of mines like the Resolution project we have in the US. Now, the Resolution project is a joint venture between BHP and Rio Tinto, with Rio Tinto being the operator. But that is the single best quality undeveloped copper resource in the United States, potentially in North America, has the potential to produce almost a quarter of the US's needs for copper. It potentially has a hugely positive impact on the administration's pursuit of greater self-sufficiency. So that project is getting a lot of support from government. It has had a number of issues in terms of legal challenge that are being worked through, but we remain optimistic that we will continue to successfully
work towards developing the Resolution project.
Brandon Craig, President of BHP America. It's great to have you on the show.
Thank you very much.
The Australian Energy Market Operator released its draft 2026 blueprint for Australia's power grid this week. The cost estimate to transform our energy grid to run mainly on wind, solar and some gas by 2050 is expected to be about $128 billion. There are many challenges on this path, including the target to have 82% renewable energy by 2030 and net zero emissions by 2050. About 6,000 kilometres of new transmission lines are forecast to be needed to support the grid by 2050, but that's down from the close to 10,000 kilometres cited by AEMO in its previous report back in 2024. AEMO also pushed out its forecast for the removal of coal power until 2049 due to the Queensland Government's pledge to keep its power stations open for longer. I spoke to AEMO CEO Daniel Westerman earlier this week.
Yeah, look, each year AEMO produce the integrated system plan. It's a 2-year process through really extensive consultation and analysis. And its guardrails are really 2 things. One is how to meet the growing consumer demand for electricity, and the other one is of course meeting government policies and targets. You're right that there are changes between the last integrated system plan and this year. So within 2 years, some things have changed. So the cost of wind, for example, has gone up. The cost of solar and storage has come down. Cost of transmission's gone up, and some government policies have changed. We have seen a clear indication from the Queensland Government that they see coal in their system for longer. The average age of a coal plant in Queensland is 30 years. Versus around 40 years for the rest of the NEM. And the average age of a retired coal plant is about 44 years. So we've reflected the Queensland policy ambition into the integrated system plan, which, as I said, is that least cost roadmap to meeting consumer needs and government policy targets.
Yeah, we know you mentioned coal-fired power stations are getting older and older, and Queensland obviously looking to retire them by 2049. But if they were to finish up earlier than that in Queensland, what impact would that have on the grid? Would our grid be ready for Queensland shutting those power stations earlier than 2049?
Well, Australia's well and truly into the energy transition, and I mean, we're sort of 15 years in. Over the past 15 years, we've had 10 coal-fired power stations retire, and increasingly that energy is being replaced through investment decisions and policy targets which favour renewable energy, batteries. You see an incredible amount of renewables and batteries coming onto the system. The ultimate backstop for reliability is gas, and so making sure that there is sufficient gas power generation and gas available for that gas power station to be that ultimate reliability backstop is really important too. So the most critical thing really is that the momentum that exists, both from consumers who are really investing heavily in rooftop solar and now home batteries and electric vehicles, and grid-scale investors who are investing in wind, in solar, in storage, so batteries on the grid, in pumped hydro and in gas, and of course the delivery of the 6,000 kilometres of transmission that we identified on that least cost pathway too.
Yeah, looking at your NEM capacity chart in the report, onshore wind, rooftop solar and utility solar all going to clearly become the dominant forms of power generation by 2050. Just talk about how much that sector is expected to expand over the coming decades.
That's right, and it's very consistent with the investment momentum that we're seeing today. So this report outlines that between now and 2050, we're going to see a 5-fold increase in grid-scale solar and storage and wind, and a 4-fold increase in rooftop solar and that's on people's homes and businesses. It also outlines the need for that pumped hydro to be delivered and for the 12 gigawatts of gas generation that we have today to be replaced as it retires and increased to 14 gigawatts of gas power stations. And that's very consistent with the momentum that exists in the sector today. So of course, consumers who are doing some of the heavy lifting of the energy transition are continuing to invest in rooftop solar and batteries, as I mentioned. But there are a significant volume of projects that are queuing up to connect to the national electricity market In fact, there's around 50 gigawatts of solar, wind and storage that's going through what we call the connection process that some of your viewers might be familiar with to connect and to construct their assets and connect into the grid. So that momentum really is there, and it's comforting to know that the plan that we've produced is very consistent with the actions that are being taken.
Yeah, and you mentioned this, how critical gas is. Just talk about why it's going to be so important in the future to act as a backstop on days where potentially solar generation might be a bit lower.
Yeah, the role of gas really is changing, but it is that ultimate reliability backstop for the electricity system. Historically, gas has played a role in what we would call peaking. And so in the height of summer, when everyone gets home and puts on their air conditioner, that's when the gas power stations, the peaking power stations, would kick in. Increasingly, that's going to change, and we're seeing it already, that gas will be really needed in the middle of winter when the sun is low and there's winter doldrums and limited wind around, and we really need the energy in the system. In fact, that already happened this year. So what we saw is that in June this year, there were several days, up to a week actually, with very low wind and low sun. And the gas demand for gas power station was some of the highest on record. So it really is changing from a sort of peaking function into that ultimate reliability backstop in winter more than in summer.
And how does this plan really help with boosting investor confidence so they have the confidence to invest and build gas projects, renewable projects and things like that in Australia in the future?
That's right. There is significant investment momentum in solar and storage and wind. What we've seen is a massive uptick actually in grid-scale batteries connecting into the grid at the moment. Part of that is due to the frameworks that governments are putting in place. So an incentive mechanism called the Capacity Investment Scheme, which is dragging through batteries and solar and wind. But it is critical that that investment momentum continues. In particular, wind having some challenges at the moment. Costs have gone up around the world. We're not the only ones going through this energy transition. Solar, as I said, has come down, so less challenges there. But we really do need those investment frameworks to evolve and keep pace to make investment attractive. The other part of that is obviously gas. As I mentioned before, we really do need the investment in gas power stations. So those investment frameworks need to include making it attractive for gas investment as well.
All right, so if investors do then have the confidence to go ahead with building these projects, what are some of the other things that could hold them up? Are we still having issues with planning approvals, with supply chains and with construction?
Yeah, look, there are many challenges in the energy transition. Australia is not the only country going through this energy transition, investing in renewable energy, replacing their ageing coal-fired power stations. And so we're seeing certainly global supply chains are challenged. Costs have gone up in some areas. And there is obviously the community concern that has been discussed, I think, at some length, as communities and individuals are affected by transmission rollout and build. So look, there's a lot to address in here, and in this report we do highlight the potential implications of a delayed rollout that could cost more. And what we see in that scenario is that the benefits to consumers are reduced, and so that means the electricity system is a higher cost to consumers rather than compared with the pace that's identified in the sort of base case scenario.
Daniel Westerman, Chief Executive AEMO, thanks for coming on the show.
Thank you.
After the break, it's been a big season of annual general meetings for investors, with numerous companies being hit with second strike protest votes against their remuneration reports. Our largest healthcare stock, CSL, has had trouble selling its new strategy. We'll recap the 2025 AGM season next. Welcome back. As the year winds down, most ASX-listed companies have already held their annual general meetings. There are still a few to go, including ANZ Bank, Orica and Insurance Australia Group. Just this week, though, some of the AGM highlights include Myer, Westpac and National Australia Bank on Friday. But to wrap up the year and the AGM season, I'm joined by Rachel Waterhouse, the CEO of the Australian Shareholders Association, and Megan Motto, Strategic Counsel at Codex Communications. Look, thanks for both of your time. Just want to start with Rachel. Why are AGMs just such an important thing to have on the investor calendar?
It's really the only time that investors get to speak directly with the board and management and ask the questions that they've got on their minds. So great opportunity. It's been a super busy AGM season and a lot has transpired over the last few months.
Yeah, it has been a pretty busy season, hasn't it? We've had some second strikes, we've had some protests. It seems to be more interesting maybe than the past couple of years.
Yeah, I think that there's been a couple of really interesting sort of highlights and themes, I think, coming out of this year. The first actually is that hybrid is now the norm. It's the expectation that there will be this broader reach using technology rather than just the physical AGM. And so I think that's been a really great thing. The technology is improved, the engagement experience is improved, companies are really getting the hang of it now. And I think that's great for shareholders, but also for companies to get that direct opportunity for engagement. I think the other thing that we're seeing is a real focus this year on governance. Companies that are seeing an AGM as a tick-the-box kind of compliance exercise are really feeling the heat from shareholders who are asking a lot deeper questions around individual directors, and the scrutiny on individual directors I think is more intense than it has ever been before. We might go into a few of those later on, but also, and that's their skills, their capacity, the reputational risk that they bring, the cross-contamination from other boards that they sit on, a lot of scrutiny around directors. And I think that that's what's made the season particularly interesting for me. It's not just the focus on company performance, which absolutely it should be, but it's also that behind-the-scenes governance expectation that's really lifted.
Well, just on company performance, CSL, biggest health stock on the market, one of the biggest companies in Australia, it has underperformed this year. They announced a new strategy. Their AGM was about a month and a half ago. It seemed like a pretty fiery affair.
It absolutely was. So shareholders really spoke up. They're uncomfortable with the strategy and the direction and management where they're going. They've got concerns around what's happening in US and the reliance and vaccines. And so they really need CSL to step up and really look through their strategy. Is it fit for purpose and how's it going to deliver? CSL is one of the darlings of retail shareholders. They love it. Most of them have it in their portfolio. So they are disappointed with the performance and they're really looking for it to grow and they need that confidence back.
Yeah, the chairman and CEO basically addressed the crowd at the AGM, pledging to do better. But I guess time will tell. It takes a while to regain trust when your share price has been eroded that much.
Yeah, that's right. I mean, 50% drop on the day of the AGM itself, 35% over the year. CSL has absolutely had a battering, and that strategy around the offloading of the divestiture of the vaccines,
part of its business.
Spinning off the vaccines unit has certainly come under scrutiny in terms of strategy. I think also the compounding effect of board renewal at the same time. Shareholders are, I think, keen to see some renewal because they're not happy with the strategic direction, but also that creates its own uncertainty. Board renewal always creates that uncertainty as well. So a lot of questions, a lot of uncertainty, and therefore pretty feisty AGM, actually.
Yeah, one of the themes you mentioned is re-voting for directors or re-electing directors. Previously, they would usually get 99, 100% votes every time, just straight in. It'd be a ticking box exercise. But now it does seem like shareholders care a bit more about who is joining their company, who's joining the board, and we're seeing some protest votes against certain people joining companies.
Yeah, we've absolutely seen that this season, and what we call it is the contagion effect. So effectively, there are directors that have had poor governance or poor performance in another organisation, and shareholders are looking around and then they're voting against them in an organisation. And they are caring, as you said before, they're caring not just around performance, but governance and governance uplift. One of the things that's been speculated a lot this season is what's happening behind the scenes and how are directors and boards effectively working with those to get their votes up. So I think there's a real genuine effort by directors to think about the retail shareholders and all shareholders and around their performance and making sure they're doing the right thing and communicating that. The other thing at AGMs is we really expect them to speak up for their election. We want to hear more about what they've done in that organisation to lift it up and what their thoughts are and what the opportunities are. And we have seen some AGMs, and I've been to quite a few as well. We're just not hearing that. You're not hearing the real why they should be on that board and how they're going to lift the governance and the strategy.
Yeah, there have been some AGMs where the person that's up for election hasn't even spoken.
Yeah.
Like it's just been...
Absolutely, and I think that directors, once again, the scrutiny is on their skills, but also on a couple of other things. One is their capacity, and this question of overboarding. Sure. Are some of these professional directors on too many boards? Have they diversified their own portfolio career too much so that they're not giving the attentiveness that they should be to the company in question? That's definitely been on the mind of shareholders. And the other really big thing is about directors and indeed executives having meaningful shareholders, having skin in the game and demonstrating their own personal commitment via their own shareholding. So these are questions that shareholders are rightly asking. Directors are more and more accountable. And as I said, the contagion effect that you spoke about, we saw that at Westpac, for example, and the contagion effect that Peter Nash saw from his ASX and the chest replacement projects, difficulties, shall we say, challenges associated with that project, really draw into question, the credibility of some of those individual directors.
Yeah, well, just on Westpac, that AGM was this week. There were environmental protests out the front of the AGM. A lot of the other, CBA, for example, have sort of faced protests like that in the past, and they don't lend to as many fossil fuel businesses anymore. It seems like Westpac hasn't really picked up on that yet.
Yeah, I think for the organisation, it's around thinking through who are their stakeholders and how they engage with them meaningfully throughout the year, so that when you do get together, it is a short and effective AGM rather than a long one, because I think everyone gets frustrated by that. And in those situations where there are protests and activists, it's really important that the chair manages the meeting effectively so everyone gets their say and gets listened to, but it doesn't stop people wanting to come back to AGMs. So they do need to think about what is their ESG approach and how do they engage meaningfully throughout the year.
Yeah, how important is it for a chair to patiently answer every question when someone turns up at the microphones?
Yeah, so definitely patiently. There's plenty of examples in the past of it not being patient. But sometimes there are the same questions that are coming through, and it's around grouping it and making sure that the overarching answer is there for them so that the meeting doesn't go for 4.5, 5 hours. And I've been to one this year that went for about 4.5 hours. And I do think that puts people off attending an AGM. It's just too long. So
that's
around
the point where you
effective.
open up the table of the party pies.
Bring out the food, everyone gets up and leaves. Look, another bank next week is ANZ. They're one of the last to have an AGM this year, right before Christmas. I don't know whether there's a thing about trying to distract people with Christmas shopping or whatever, but the new chief executive's announced he's cutting bonuses by $32 million for his executive team to try and appease shareholders. Do you think that's enough to keep people on side?
Look, ANZ obviously going through their restructuring at the moment. Serious questions given their performance. Pay's been up, but profits have been down, and that combination is never something that's healthy for an organisation. Particularly getting those operating costs under control, I think, is something that's very much in the mind of shareholders, and a lot of scrutiny is on that. They've also had a bruising time from a regulator's perspective. They've had some serious issues over the year, and so that clean-up is still ongoing, and I think it will take a little bit of time for that to continue to play through. I think the bonus slashing is obviously an eyes-wide-open attempt to avoid another strike on the REM report. Whether that will be enough or not, I'm not sure. REM reports, as we know, are really one of the only opportunities, the only levers that shareholders have to protest broader happenings in an organisation. And so oftentimes the voting down of the REM report may not necessarily be about the remuneration structure itself. Slashing those bonuses is a way to try and mitigate that, but there may be a protest vote just because of the general performance of the business.
Yeah, well, a good example is Reece Plumbing got a huge second strike. Really, it wasn't about the management. It was more just the company wasn't doing very well.
Yeah, it's around the performance and decisions that have made around the US. So that's the issue there. But with Reece and looking at the whole AGM season, there's also the importance of the independent lead director effectively, because when you see the founder-led organisations and you want to lift the governance, that role is critical. So we've seen that in a few different organisations around, is that person really independent and how they can add value. But Reece is an example of performance and concerns coming through in in the remuneration voting side. And on the ANZ, I think that's another example of why skin in the game that Megan mentioned is just so important. We've got a director there that we're undecided on because they don't have enough skin in the game, and we want to see them aligned their interests with shareholders. So we'd like to see more of that. There is a good example with Next DC where we, from memory, we're undecided on one of the directors, and they committed to buying shares and getting skin in the game at the AGM itself. So that's something that we'd like to see more of, those decisions before an AGM. But if they're not before the AGM, a commitment from directors to invest in the company themselves.
Rachel Waterhouse, Megan Motto, thanks so much for your time. Appreciate it.
Thank you. Good to be here.
Australians undergoing medical treatment often rely on family and friends to drive them to and from health clinics and hospitals. But if they can't get a lift or can't afford the transport costs, they miss out on their treatment, and the appointment often doesn't get filled, going to waste. Uber Health's technology platform is helping address this issue, partnering with organisations including public and private hospitals, along with not-for-profits like the Hunter Breast Cancer Foundation, to provide reliable, safe and affordable transport to appointments and treatments. Carly Chatfield reports.
Most of us take access to transport for granted. But for those with critical healthcare needs, transportation can be a barrier to better treatment. Cancer patients like Jackie often have no choice but to rely on friends and family just to make their appointments.
Well, my main transport was through my friend. He's got bad health problems.
Christine Cockburn is CEO of Rare Cancers Australia. She has seen the struggles cancer patients face travelling to appointments.
Access to transport for people living with cancer in Australia is a huge burden. The burden of actually driving or being driven whilst you're going through the stress of cancer treatment is a massive barrier. It's a really difficult time for people, and transport is just an extra level of stress sometimes.
A landmark survey and report by Rare Cancers Australia found respondents living in regional and rural areas are 3 times less likely to have a recommended treatment because of the distance between home and the treatment centre.
What we know is that people will avoid travelling sometimes if they have to, but also the saying no to appointments and saying no to care sometimes, which is an absolute tragedy, just because it's burdensome, it's complicated, and it's expensive to get around and to attend those appointments.
For Ash Cabriti, Global Head of Uber Business, Uber Health and Transit, the goal is clear: to make healthcare more accessible by providing patients with safe, affordable and reliable transport to every appointment.
What we see in Australia is a lot of people are not able to get access to healthcare solutions because of long distances, because of the cost, frankly, of mobility, and because of big transport gaps.
Uber Health partners with organisations including public and private hospitals, aged and home care providers, clinical trials, Aboriginal health organisations and NFPs to provide reliable and affordable transport to appointments and treatments. The patient does not pay anything. It is included in the services of the healthcare provider.
We partner with hundreds of healthcare and transit organisations across Australia, both from the large hospitals down through to clinics and transit agencies. And what we're able to do is to help them solve some of the hardest issues in society today around making sure that patients can get access to safe, affordable and accessible transport. And frankly, that transit agencies are able to ensure that people can get from A to B in a safe, reliable and accessible way.
When Jackie's only mode of transport fell through, her nurse recommended she contact client care navigator Marianne Timbrell Chapman from the Hunter Breast Cancer Foundation. The foundation partners with Uber Health to provide transport for patients.
Having the knowledge that they can call me at the Hunter Breast Cancer Foundation, have all their radiation appointments scheduled in on time, know that they'll get a text message from me the day before telling them who's going to be picked up, at what time and what time they'll get there. It just is that little tiny thing that makes life just that little bit easier for them.
I rang and I spoke to Marianne and I didn't think that it'd be able to be done with, like, you know, being such short notice. And she just said, yep, sure, I can do that. And not only that, but she got a hold of my schedule for all my other treatments, and she made arrangements for transport for me.
Uber Health has helped boost the number of patients making it to their appointments, closing the gap between getting there and getting care.
Rare Cancers Australia has worked with Uber Health for almost a year now, and I know from our cancer navigators on the front line supporting care for patients that it has certainly opened up a whole world of new support services that we can offer.
Uber Health doesn't just help patients, it also supports the organisations it partners with help provide patient care in ways traditional transportation cannot.
You can think of the Uber Health technology as a simple, easy-to-use dashboard where organisations can book rides for patients either on demand or up to 30 days in advance. And you can book it through the website or flexible via text messages.
Uber Health is really flexible. If an appointment goes over, for example, it's a really simple thing to kind of swap and change things, and that is a barrier that we're so very happy to be able to remove for people.
For patients like Jackie, getting to appointments is now stress-free, so she can now focus on her health and not the ride.
Well, now I am able to get to my appointments less stressed. I don't have any worries about getting to my appointments anymore.
Uber Health has bridged the gap between technology and patient support, ensuring a future where appointments are easier to reach and healthcare is more accessible to everyone.
What I love about Uber Health is the ability to use the tech and the operations that we've built and to be able to solve a huge societal issue in this country. And I'm really excited to see the way in which we can improve access for people, we can make healthcare more affordable, and frankly, we can make sure that people are able to get to their appointments.
Coming up after the break, the property market's had a strong year with national prices rising about 9%. With the Christmas break looming, we'll wrap up the key events of the year, including the newly established First Home Buyers Scheme with REA Group. Up next. Welcome back. National home prices surged to a new record high in November, but the pace of growth has been slowing down. According to PropTrack, in the year to November, property prices have risen almost 9%, adding about $78,000 to the median value of every home across Australia. So to wrap up the year in property and preview what's in store for 2026, I'm joined by Anne Flaherty, economist at REA Group. And thanks for your time. Good to see you. It has been a pretty good year, really, when you look at how much prices have gone up over the past 12 months or so.
Yeah, it has been a good year, and I think what we've seen is that the impact of 3 interest rate rises, which has improved consumer sentiment, improved seller demand, or seller confidence, I should say, has really lifted activity, and we've seen pretty decent price gains in most markets.
Yeah, are there any cities out there that have done really well over the past 12 months?
Look, our top performers are Adelaide and Brisbane and Perth. And what we've seen in these markets is that really strong home price growth momentum we were seeing last year has flowed through into this year as well. And while we have seen a lot of stock for sale in Melbourne and Sydney over recent months, those other 3 markets have not seen the same increase in properties for sale, which means that there's still a lot of competition for homes coming up for sale. And again, I think that's one of the reasons why those markets are continuing to overperform.
And when do things quieten down for the year? Obviously, we're getting really close to Christmas now.
Well, it's just about to happen. We're having our last busy weekend this weekend, and from next week, we're really going to see things quieten down. Now, we normally don't see the market pick up again until the end of January, but you know, what we saw last start of this year was a little bit different, a bit more activity earlier on than we expected. So it'll be very interesting to see if the same scenario takes place next year.
Yeah, what sort of demand are you seeing right now on the REA Group website for property listings?
Look, we've actually seen some very strong demand. If we compare November with October, there are fewer people searching for properties. But if we compare November of this year compared to last year, we're seeing a percentage rise in the number of searches in every state around the country, the only exception being Queensland, where they've held steady, but that's at a very high rate. So I think that that's a strong signal that in the new year, there's still going to be a lot of buyers out there looking. Of course, a lot of people who are searching for properties in November, they're not looking to actually make a purchase until the new year.
One of the big policy changes this year was the introduction of the first home buyer scheme. It's only been around now for a month or a couple of months. Is that having much of an impact yet on the property market, or are you expecting to see a bigger impact in calendar year 2026?
It depends where you look. If we look at the home price growth data, it hasn't had too much of an impact yet, but we spend a lot of time talking to people on the ground, whether they be agents or buyers advocates or banks, and we're actually seeing an enormous amount of activity. So for example, we've already seen a slowdown in the rate at which loans are being processed because of this upswing in first home buyer demand. We've also seen that some properties that are being put up for sale in more affordable regions, for example, Western Sydney, we're having queues going out the door from what we're hearing. So there's a lot of first home buyers out there looking to take advantage of that scheme. And I think that it's inevitable that next year this is going to really drive an increase in home values, particularly in those suburbs where we have median values beneath those price thresholds.
Yeah, when you look at the amount of stock on the market at the moment and are expected to come onto the market in the new year, is much of that affordable, or would a lot of those homes be quite expensive to purchase?
Look, unfortunately, the vast majority of homes that are put up for sale are not what we would call affordable. Less than 1 in 5 homes that are put up for sale in Australia would really be classified as affordable for a first home buyer on a median income household. So it is really challenging out there. Having said that, unfortunately, the reality is that a lot of people out there buying homes that, they're not first home buyers. So when we just look at first home buyers on their own, they're not really the main driver of what we see with prices happening as a whole. There are a lot of people out there who've experienced enormous equity gains in the value of their homes in recent years. Around a third of homeowners, or actually close to half of homeowners don't even have a mortgage. So there's a lot of wealth out there that can be contributed to the property market. And I think that makes the value of housing a little bit more resilient to interest rates as well.
Well, you mentioned interest rates and the 3 cuts from the RBA this year. Now it looks like the Reserve Bank could be on hold for quite a long period of time, potentially increasing rates in June or at least by December 2026. I mean, what's that going to do to the property market in 2026?
Yeah, it's interesting. We're seeing that the market's pricing in the chance of a rate hike by the end of next year. And I think if that does happen, of course, that is going to impact home values to a certain extent.
Anne Flaherty from REA Group, great to have you on the show.
Thanks for having me.
Well, that's all for the show this Sunday. Up next is all the latest news right here on Sky News. Business Weekend returns in January, but don't forget you can keep up with all the latest business news with our daily program Business Now at 4:30 p.m. Eastern Daylight Time. Thanks for your company today. I'm Edward Boyd.